We start off with the banks. A mixed bag at first after facing the Fed's stress test moments ago, but check out some of the biggest players now. Goldman Sachs, Morgan Stanley, Deutsche Bank, Citi, Wells Fargo, all higher right now. Let's get to Leslie Picker in the newsroom for all the details. Leslie.
Hey, Melissa, that's right. Deutsche Bank's U.S. unit failed to receive approval from the Federal Reserve to move forward with its capital plan. The remaining 34 banks tested by the Fed were approved, but Goldman Sachs and Morgan Stanley will be required to maintain their payouts to levels from recent years, and we've seen that with the announcements coming after the close today, a so-called conditional non-objection to their capital plans. This result was actually somewhat of a surprise after the two firms issued statements last week hinting that their ability to distribute capital may be better than what appeared from the first stage of the stress test. That's largely thanks to a one-time capital reduction under the new tax law. The Fed also issued a conditional non-objection for the capital plan from State Street over its management of counterparty exposure under stress. No firm that was tested that their plan was rejected on quantitative grounds. Deutsche Bank's U.S. unit failed to receive approval on qualitative grounds based on what the Fed determined to be a material weakness in their capital planning process. That will limit Deutsche Bank USA's distributions that it can make to its German parent company. They will need to get approval for any payouts from the Fed. Now, Goldman, Morgan Stanley, and State Street's conditional non-objection was on quantitative grounds. Citi raising its dividend by 41% to 45 cents and allowing a $17.6 billion buyback. JP Morgan boosting its dividend by 43% to 80 cents a share and announcing a $20.7 billion buyback program. Morgan Stanley raising its dividend by 20% to 30 cents and buying back $4.7 billion worth of stock. And Goldman Sachs raising its dividend to 6% and announcing a $5 billion buyback program. Now, it's important to note that Goldman and Morgan Stanley, of course, received that conditional non-objection from the Fed, meaning that those payouts in totality should be similar to those in recent years. Melissa.
All right, Leslie, thank you for that roundup. Leslie Picker in the newsroom. Well, the banks did manage to snap its longest losing streak in decades today. So are these results good enough to spark the rally in the banks that Wall Street has been waiting for a very long time for, Tim?
Look, I'd like to say that this is what people have been waiting for. I don't think we got anything that different other than maybe some of those non-conditionals. So why wouldn't you have priced in Citibank at a 2.8% dividend yield last week, which, by the way, is what it has. And by the way, I think it's pretty impressive. And by the way, I think Citi is the most impressive of all of them because of how cheap it trades to the group, probably 15 to 20% cheap. So does this change things for the banks? No, but I'll also tell you, look, the banks, if you had a thesis 3 months ago about why you were a bull on banks, to me, I've seen nothing that has changed that takes me away from that thesis, and I am still bullish on the banks.
I agree with everything Tim just said. I think, had the banks been where they were 6 weeks ago when they were much higher, this would have been a complete non-event. They were just, the bar was so low going into this. I also agree, Citibank, that's a very big buyback. I mean, $17.6 billion for them is over 10% of the float. So, and that's going to be very accretive for them. So, Citi, I've been a bull for a long time, and it's just gone down every day for the last, 13 days until now. This is
Actually,
great, but it doesn't change the story. But it was up.
Have at it, Dan. There you go. Come on, buddy.
I think
Come on.
I mean, sorry to cut you off, Karen. I think one of the most.
You love cutting me off.
I think the most important thing is that if whatever you're pricing for the dividend last week is what you're pricing now, and I think the buyback. Obviously, you tell me what was the delta on what you were expecting? Was it 10% greater? You know what I mean? It's just it all is what it is.
We're saying all the same thing. I don't think they're nice. It's great. I don't think the stock should have ever been here.
Right? They're up after hours. So that would suggest that they weren't priced in.
I mean, they were so oversold.
Okay, well, but they're still up, so that means they weren't priced in. So this is new information. That's what the market's telling you. I think the buybacks are actually a pretty big deal, and they better be a big deal because the banks, as Dan has mentioned, have been wilting on the vine for most of the year. So these buybacks, I think, could be the thing that does spark the rally.
I just want to say something about banks because I feel the need to defend the sector, even though, it's not like this is where I live every day. Banks have outperformed the S&P since the elections. Let's be clear.
Barely. Tim, hold on.
Okay, but think of all the pushback I'm getting from you.
I think the S&P is up 27%. The XLF is up 27%.
But why are we talking about banks
because you're seeing massive underperformance at this stage in the cycle. You're seeing massive underperformance when the yield curve is about to invert.
Now, look, Dan, we've seen the banks outperform, then underperform, underperform multiple times in the last 2 years. Bottom line, people saying that banks are underperforming, they're not. Okay, if you pick your time period, you can have an argument.
I say this a lot over the last couple months.
Look at the charts.
Yeah, they're both up 27% since November 8th, 2016.
Oh, actually,
so they're in
more.
lockstep.
Banks are up more.
I don't believe so. Okay, so so they're underperforming this year.
They're underperforming by 13% from the highs. I get it, and that's the whole reason. Do I want to sell banks into the holdout? I mean, if anything, the fundamentals are the same, as I said, and I think after being oversold, underperforming by 13% since the highs of the market in January. If that's what you want to call your trade,
everybody who's been selling banks all year long, now the banks are actually going to buy a little bit more stock from you. How's that? Okay,
I'm not talking about that. I'm talking about fundamentals for the banks that, by the way, continue to be very good. The valuations in a market where I think we're getting multiple compression for the S&P. The banking sector is the one place I feel really good about.
Well, let me ask you then. I mean, if the multiples are, the fundamentals are the same three months ago, 3 weeks ago, whatever the time period is, and the bull case was there. Why do you think the shares haven't reacted better, Karen?
They're not whatever's in vogue. They clearly weren't in vogue. I don't believe that the market's always efficient. They shouldn't be here. That could persist for some time. I mean, we've seen that with we've seen whole industries move in a very big way, all in lockstep, which just, momentum.
And you've had the yield curve flattening, right? Which, Tony Dwyer will tell you that the banks outperform when the yield curve first flattens. But most people are sitting out there saying, oh, wait, flat yield curve, banks can't perform. So actually, I think this is an opportunity. If they are going to start lending at a bigger level, more volume, then it's actually an opportunity to buy the banks at these levels.
I think the biggest problem that I have with this whole scenario in 2018 is that we have FANG again just going gangbusters. And this is a group that people think it doesn't really matter what's going on in the U.S. economy or the global economy. The secular shifts are in place, and they are absolute monopolies, okay? So the bank stocks are supposed to be, the banking companies, the major beneficiaries from this tax cut that we got late last year. So why is it that we're seeing this crowding into this group of stocks that actually doesn't need the tax cut for growth, and you have the group that's supposed to be the biggest beneficiary acting like,
I'll tell you why. First of all, I don't think they're supposed to be the major beneficiary. I don't know where you're getting that.
Really?
I think, yes, really.
Banks are the lifeblood of an economy?
You're the one saying that. I would put it more towards manufacturing companies. I would put it more towards
every day in the Wall Street Journal and on this network.
I think you just used the C word. Well, look, the bottom line here is if you think about what banks have right now, I think they are the most levered to an economy. We got 2% GDP final in the first quarter, which, by the way, nothing to do cartwheels over. Best GDP of first quarter in 7 years, okay? Banks are most levered to the economy. They are, to me, the sector that makes the most sense in a world where we see operational leverage in their businesses. They've never been more efficient. So I'm just going to tell you that I don't think banks have really underperformed all that much. And I will tell you that I don't think you should be expecting miracles. I would also say that the target's been taken off their back. If anything, that's what people got excited about. Banks were vilified, rightly or wrongly, and it's clear they're being allowed to do their business as usual.
Right here, right now, $1 into banks or $1 into energy?
$1 into banks, better risk reward.
Right here, right now, $1 into. Oh, I'm not going to ask you. $1 into banks or $1 into tech?
What's my time period, Mel?
6 months.
6 months. I think energy's got more to do. Higher beta, though. And I think after this, right now, energy's had a huge run. If you told me 2 weeks, I'm in the bank trade all day long.
Does it matter, Karen, that it seems like everybody who comes on CNBC they're bullish banks. They recommend people go in banks. They're overweight banks.
Yep.
Where something like an energy, I picked that because there's general consensus that people are underweight energy exposure.
Right. Yes, I think there's something to that, though. But for me, I think the bank issue right now is so compelling. I don't care that it's out of favor right now. I totally agree with Tim. Also, the economy is so important for banks, and it's humming along. All right. And they went up before today's CCAR results.
Right.
They were up today before that.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.